Governor, we're live.
All right. Well, good morning, everyone. I'd like to call the emergency board meeting to order. And for those of you watching from afar, materials to follow along with this meeting may be found online at aoa.vermont.gov/revenue. So we'll pick up agenda item number 1, private activity bond allocations for the year 2026. Currently need two motions. I'd like to invite the treasurer to repeat that to assist us here.
Well, thank you, Governor. Nice to see everybody this morning. And I'm with me is Scott Baker from our office. So we just have a very brief presentation and 2 motions to make on the private activity bonds. Just for a refresher for the e-board, the activity bonds are for things that benefit private entities. The tax code allows for them. They're still tax advantage status of a tax exempt, but they also put a limit as to how much a state can issue. So the limit for Vermont for this year is just under $400 million. And we have also surveyed the various entities in Vermont in terms of what they would expect to use for that cap for this year. You're going to have heard from VITA and the Vermont Bond Bank, and then the others, the Vermont Housing Finance Agency and VSAC. So VITA at this point is a $60 million amount, and the bond bank $30 million amount, and the rest for contingency. But then usually toward the end of the year, that contingency gets spread between those agencies. But that's an initial recommendation in terms of the allocation. So there's a motion for that in the materials, and then also a motion for the bond bank to be able to allocate some of their allocation to municipalities if that is something that they feel is reasonable and justified.
Any questions for the treasurer? Yes.
Has the bond bank ever allocated any of their bond, authority to municipalities?
I think in most cases, they just do the lending, the bonding themselves.
Rather directly.
Yeah,
Because that's what they're there for.
yeah, exactly right.
But this just gives them the opportunity if the case is.
Yeah, exactly. It's just the flexibility.
Other questions? All right, like to ask for a motion.
I will make the motion to approve the Vermont private activity bond allocation of $397,625,000 for calendar year 2026, as recommended in the letter from Treasurer Pichek to the Emergency Board dated January 12th, 2026. Do you want me to make 2 default parts of that motion? Or is those 2 separate?
We'll do 2 separate ones. Is there a second? Is there any other further discussion? All those in favor, signify by saying aye.
Aye.
All those opposed? The ayes have it, and you've approved the first motion. Now we have a second motion.
I'll make that motion as well. I will make the motion pursuant to its authority under 32 BSA subsection 992 that the Emergency Board grants the authority to the Vermont Bond Bank to assign any portion of its 2026 private activity bond allocation to 1 or more government units as defined in 24 BSA subsection 4551.
Is there a second?
Second.
Further discussion? All those in favor, signify by saying aye.
Aye.
All those opposed? The ayes have it, and you've approved the second motion as well. Your work is done. Thank you very much.
Good luck.
Thank you.
Now picking up agenda item number 2, the official state Medicaid report. A motion will be required. I'd like to invite Nolan Langwell from the Joint Fiscal Office and Tracy O'Connell from HF to present the report. Thank you very much for joining us.
Good morning. Morning. For the record, I'm Noel Langwell from Fiscal Office.
For the record, Tracy O'Connell, Chief Financial Officer for the Agency of Human Services.
As the governor just said, we're here to present the Medicaid program estimated caseloads and member per month expenditures in fiscal year 26 and 27. As you know, these estimates are based on consensus estimates by the Fiscal Office, HS, DIVA, and Financial Management. We do our best to come up with estimates with the best available data to us at that time. If you recall, in July, we presented you with a year-end report that showed decreases in enrollments from across most Medicaid eligibility groups, yet there were still increases in utilization. For fiscal year 26 and 27, we expect that trend to continue, but not quite as dramatically. It's kind of hard to pinpoint what specifically is driving this trend of up utilization and down enrollment, other than the fact that they're seeing Medicaid programs across this country are seeing similar trends. Finally, some of the provisions that are in HR 1 federal reconciliation bill will take effect in 27, specifically to increase the frequency of redeterminations in Medicaid from 12 months to 6 months, which would have an impact on some enrollments, and as well as work requirements for the new adult expansion population. The big one on my mind is the provider tax one, but that won't take effect until fiscal year 28. But enough good news. You have your motion before you, and I think that's really all we have to say.
Any questions? Yes.
So you're seeing significant declining enrollment. And as you said, some large degree of that is separate from the federal action.
Yes.
Okay.
We've been seeing this trend sort of post-pandemic. So during the pandemic, enrollments spiked, and now we're seeing those enrollments drop, but the utilization is still up. So Jason wants to add.
And I remember when they went down post-pandemic because there were a lot more redeterminations and that sort of, I thought we expected them to plateau from there.
And I think we are starting to see them plateau towards the end of 26 and 27. The 27, there is a slight decrease that we've taken into account because of HR 1. But we're certainly starting to see it plateau. In fact, we're pretty much at levels that we were pre-pandemic, back to levels in early 2020.
Yes.
Thank you. The decreases seem to be in the two new adult populations, the childless and the new adult with children. And I know it's also called the expansion population. And I think that's the group that has the most number of requirements that are going to be happening either now or in the near future. Do you think that's having something to do with this at this point, or any thoughts on that?
I think that when we did our projections, we try to take that into consideration, but the reality is we won't really know what this will look like until it happens. You know, Fish and I were just reminiscing about the days when you had 15 years of experience with no changes,
Right.
and you could make these constant trends. And now there's so much volatility. We do our best, but it's hard to know how much drops should we anticipate. You don't want to overestimate, you don't want to underestimate.
And to reiterate, other states are facing challenges.
And is it with the same population?
Yes.
Okay.
Is it related to demographics?
It's a great question. I'm not sure about that.
Fewer kids?
Let's leave them without.
You know, this was also the population that prior was in VHAP and Catamount, and there was a lot of churn in that too, in those programs. So I think we're just seeing the same population with a similar churn.
The new adults with children, are those children expected to be insured and just the adults? Just the parents or not?
If they're below 300%, they're usually not eligible.
So in these estimates?
Oh yeah, they are.
Okay.
Any further questions? Have a motion? Go ahead.
Previously in some conversations about this, there was sort of an assumption that the folks who were not enrolled anymore in that churn would be sort of moving over to the exchange. Is that part of a conversation you had, or is that sort of beyond your purview?
Well, no, we do take into consideration exchange. However, with the change in the federal law that's expanded, I was on a call the other day with someone from DEVA, and they were talking about how this year they've seen a big drop because of the federal changes. Even though they're still eligible for the state subsidy, they're still seeing that drop. And so again, it gets into that. It's hard to know where these people are landing. A lot of them will be uninsured. Some will go to the exchange. Some may find other sources. It's hard to really know where they're going to land without any kind of experience. It's a great question. It's hard to know.
Have a motion?
Yes. I make a motion to accept the Vermont Medicaid program's estimated caseloads and estimated per member per month expenditures for FY26 and FY27 as explained in item 2 in the meeting materials.
Here, second. Any further discussion? All those in favor, signify by saying aye.
Aye.
All those opposed? Guys have it, and we've approved agenda item number 2. Thank you very much. Now we'll pick up agenda item number 3, additional state revenue estimate will be required. I can invite Jeff Carr and Tom for that. Present the consensus revenue forecast. Morning. Welcome back.
6 months ago.
Yeah.
I would say you're gonna be as steady as she goes part 2. If I'd taken that deal in a second. And so
That's where we're at.
Yeah, where we are.
This is probably one of the least eventful forecast updates in terms of percent change relative to the prior forecast that we've ever done. And that goes back a number of years. So it's not that nothing's happening in the economy. It's just that the way it all sugars off balances some of the risks, and that the prior projections were very close. If you look through the first 6 months, we're within 1% on all 3 major funds. And so it's not like there was some, huge thing that's going off the rails or some good thing coming in that we weren't aware of. There's a lot of uncertainty still, and so there's a lot of risk, but there's upside risk and downside risk to this, even though a lot of the numbers are big. But the change from the last forecast is quite modest.
And in the G fund, general fund, a lot of it comes from the healthcare taxes and funds side. The biggest downward adjustment. As a matter of fact, if you look at the general fund, excluding healthcare, we only had a 2.9%, $2.9 million forecast rounding for 2026. We actually have a $2.8 million forecast upgrade for 27 and a $1.7 million forecast upgrade for 28. So a lot of the action is happening not in the not in the non-healthcare things, but because of what happened with the one old BBBA Act and the limitation on provider taxes. I think that's constrained healthcare revenues going out into the future.
Right. So in the standard general fund categories, the category that gave us the most concern was corporate income tax. And we did a pretty deep dive. There's a chart on page 8, even though the page numbers are a little bit obscured because the chart, but it's the it shows corporate revenues seasonally adjusted. These are quarterly rates, and we seasonally adjust the data in order to analyze it because you want to take that out of it. But you can see how volatile corporate is, even after seasonal adjustment. It can swing around a lot, the way payments come in, the way refunds come in. And we got a lot of refunding, even more than we expected in November and December. January is a fair amount too, but so far not like November, December. And we looked at the refunding, we looked at carry forward flows, and we looked at some payments that, hadn't yet landed. And try to look for patterns, see if there was something in the current environment that was affecting corporate profits and corporate liabilities. And we really didn't find a clear connection with current conditions. A lot of these refunds were based on prior year tax liabilities, payments that were made and then true ups later, returns that were under review by the tax department and then it gets settled. And so it's not like we see corporate profitability in general eroding. If you look at national corporate profitability on the next page, corporate profits through the third quarter of 2025 are, record levels. They're just keep churning in. The next page shows, like, if you look at it in groupings, we've got 21 consecutive quarters of year-over-year growth in corporate profitability at the U.S. level. And given the current apportionment schedule, the single sales source, our profile of corporate payers looks a lot more like the U.S. than it ever used to. So
it's not like this is a generalized issue. I think there's a lot of it is the normal volatility that occurs in corporate. And even though we've downgraded corporate in the forecast, there was some improvement in personal income that offset that. So the personal income over the 3-year forecast period, 26-28, offset about 71% of the forecast downgrade in corporate. And when we get out in the fiscal planning years, we get out 5 years, we look at it on a change. Remember, 31 wasn't forecast last summer, so we only go out 5 years in the comparison change. It dropped to 41% because corporate loses a little bit of ground in 29 and 30 going forward. So it was helpful that categories like personal income withholding, which if you were looking for economic weakness, you would expect that to decline. It was pretty solid. We had a little bit of softness in the end of the year estimates in personal income, but personal income estimates for the fourth quarter through December 31st are a lot less instructive than they were before we went to the higher standard deduction. So we don't spend a lot of time looking at it. And so far, and I just was looking at the mid-month numbers, it looks like the personal income estimated payments are actually doing pretty well in January at the halfway point. And just remember, the due date was the 15th, but everybody's paying electronically nowadays. So, it comes in a lot faster than it used to with the mail, but we're still allowing people to pay by mail. So we still get some big checks by mail. So we usually wait till the end of the month for that. So that was good. Refunding was just about where we expected it would be over the first half, a little bit heavier, not that much. And then the other catch-all category that has fiduciary payments and all that kind of stuff in it was a little bit light going forward, but personal income, most of the first half of the year relative to consensus expectations was from withholding, which gave us a little bit of comfort when we were doing the forecast that, aside from what tariffs may be doing, the corporate margins and things like that, which may be affecting things a little bit going forward, and corporate income tax for all the things that Tom said earlier, there's still this dynamic of balancing risk between the two income taxes. The only kind of unnerving thing about that is both personal income tax and the corporate income taxes are about two of our most volatile sources going forward. So what happens is, in order to stay relatively small in terms of the forecast, what happens is we put a lot more pressure on the spring personal income tax filing season. So if we don't make our targets in April, there ain't a heck of a lot of time to fix things before the end of the fiscal year. So in the terms of the risk, and if we had had a few more days to do this instead of the 6 fewer we had this year to do it, when we got done, we would have spent probably 3 days looking into that particular question a lot more deeply than we were able to. So it's despite everything that's been going on, and despite a lot more concern about what's actually happened from the on again, off again tariffs, and there's enough exclusions and tariffs to drive a truck through most of the time. And I guess we just got another trade agreement with Taiwan on chips overnight. I'd have to spend a full time monitoring the trade agreements, instead of some of the ones that are going on. And then since everything's still so much of the product flow between us and Mexico, and to a lesser extent Canada, is still covered by the free trade agreement that we did with the previous Trump administration, that it's a little surprising that tariffs haven't been a lot more damaging than they have. I think they've been problematic. I think we're starting to see that in some of the national employment numbers, where for a 3-month period in the fourth quarter of last calendar year, 2025, we actually saw a decline in non-farm payroll jobs on the national level. So we're still looking at the next 6 months. We're taking this in 6-month bites, really. And I think you have to, because a week is forever. I have to go home at night and turn everything off at 8 o'clock because I won't fall asleep until 1 a.m. But it's a lot shorter of a time frame. And I'm actually, from an economic standpoint, not from a humanitarian or policy point, happier that they're more focused on foreign policy than they are ruining the economy.
Yeah, there's no question that
the tariffs and immigration policies have been big headwinds to the economy. And the tariffs have been watered down and, all the rest. A lot of it has been absorbed by the sellers and the middlemen in it. And that's just not going to last forever. I think there's concern and hope among some that some of the tariffs will be invalidated and might even be refunding and things like that. But both those two policies are real headwinds that slowed GDP growth in 2024, real GDP growth from 2.8 all the way down to about 2.0 in 2025. Would have been stronger, but for those. But tailwinds, AI has been this enormous tailwind that in investment was a big part of the GDP growth that without that, it would have been, way down. And immigration also, we're just not, getting the job growth. There's a lot of economic benefit to having more people in the labor force. And so, the headwinds and tailwinds, another tailwind is going to be money from deficit spending associated with the Reconciliation Act. And then there's talk about tariff rebates, a $2,000 tariff rebate. So far, those plans, to the extent they've been fleshed out at all, any of the plans that have been talked about would exceed the amount of all the new tariffs collected and existing customs. So they're talking about deficit spending on top of deficit spending. It's, and again, short term, it gives the economy some juice. I think there's some intent to keep things as juiced as possible through November and maybe a little longer. Yeah. But that seems to be the focus. But when you pile up deficits like that, I got a bunch of charts on this one.
Yeah.
It's not like you get an immediate cost, that you see, so it crowds out some private investment. It's going to raise longer term interest rates. But when the bond markets really get skittish, when do they think it's too much? When are they, needing higher interest to hold those notes? It's hard to say. But that's a real risk when in good times we're running those kind of deficits.
The data center numbers that push private investment in the GDP accounts in the first quarter was a 9.5% growth rate. In the second quarter was 7.3%. And then the third quarter, which is the most recent quarter, was only 2.8%, but it still helped the economy go forward. And when you look at AI and when you think about the .com thing and all that kind of stuff, if you think about AI, it's got all of the elements that have led to the previous bubbles. It's got overhyped technology. It's got a heck of a lot of real estate investment and putting together data centers. And the federal government anyway has been euphorically talking about how great it is. Those are all three things that can lead to bubbles. And so, but I mean, it's been carrying the economy along with consumption. And, you look at equity market returns, stock markets.
It was a big part of the stock market is the AI.
Yeah.
Take the AI stuff out of the stock market. 75% of the growth since 2003.
I mean, the good news is the last couple of weeks, it's the leaders are starting to reemerge in different areas and leading the stock markets. And you would expect that. I mean, it's still a 4-year bull market in stocks, which has been very helpful to personal income collections as well. We love unanticipated year-end capital gains. That people get credit to their accounts for spring filing season. But, we've managed to be okay for 6 months, but there's a lot of stuff happening around the economy's kind of fraying a little bit around the edges now, and it wouldn't take much. Particularly when you look at where household confidence is right now, where business confidence is right now. I mean, think of it. We've had over 3% growth and GDP in the third quarter with virtually no job growth. We're going to have growth in the fourth quarter in GDP with job loss. This is no hire, no fire economy is just not the way. Now, from the standpoint of labor force growth, maybe you don't have to have much, job growth anymore to keep the unemployment rate where it is when you're losing a source of labor force growth that the last 4 or 5 years has been pretty high, which has been from the immigrant population. But it, the labor market in a traditional sense is always the insulating force against the general economic downturn. And when you look at what's going on now in labor markets, and that's part of the concern why the Fed cut the last half of last year, was they were starting to see things happening in the labor market that was of some concern. You have to keep an eye on what's happening in the labor market, and that certainly, I mean, equity markets can turn, corporate income tax turns very quickly, and when it turns, it's hard to, when the worm turns, it's hard to bring it back. So it's not like we're saying smooth sailing ahead. It is, it's like on Golden Pond, we're taking the boat into Purgatory Cove. We need to have somebody up on front saying, rocks over there, rocks over here, and, keep trying to avoid them. And I wish I had more confidence in federal administration in that front.
Yeah, and that dependence on AI and consumer spending through the wealth effects of all this asset appreciation is created a real bifurcated economy, described as a K-shaped economy, where some people are seeing everything go up and a lot of people are seeing things go down or be stagnant. And you see that in consumer spending. It's persisted even with really low consumer sentiment in large part because the top 10% of income earners are responsible for 49% now of all consumer spending. So that's that's kind of a narrowing of it. And a stock market crash ripples through more quickly than it might otherwise.
Perfect example of playing out in revenues with the motor vehicle purchasing tax. We were worried about it through September in the aftermath of people did a lot of pre-tariff anticipation buying in the early spring, and then it fell off in the April to June quarter. Didn't do particularly well July to September, but October to December, it outperformed expectations, and combination of the E fund and the transportation fund and education fund by $3.4 million. That was over 9% over performance. Right now, the average vehicle is closing in on $50,000 a year. There were more vehicles sold in November at $75,000 enough than there were $30,000 vehicles. And 20.3% of new car payments were over $1,000. I remember you could get a pretty decent condo for $1,000 mortgage payment back about 25 years ago.
Are you keeping track of the number of vehicles sold as well as the costs are up? So the income is up, the sales of the tax revenue is up. Because it costs more.
Yeah.
Right? So are we keeping track of
Well, there are caps on purchase and use tax payments.
number of vehicles that are being sold today, let's say, than 10 years ago or
National level, mostly. National level, we have data on that. We don't have really good data as much as we used to.
Yeah,
In the state
we've
level.
got some discontinuities with some of the state data that we used to rely on for that. I'm hoping we can somehow patch the discontinuity so we can look farther back, but it's kind of hard to tease that out of what we have
well,
now.
even like any of it, personal income, anything. It's all elevated due to.
Well, we have pretty good data. We have pretty good data on the income taxes and who pays and the number of payers and things of that nature. It's just not as good on the vehicle side.
Yeah.
And the other thing is, since we're not acquiring registrations and stickers and stuff like that, we don't know, a little bit about maybe some people are driving around cars that they used to register that they're not anymore.
The further question on the transportation, so despite what you just said, you're downgrading in FY 26, but you're increasing FY 27. Is that all just around purchase and use? Are there other?
Oh, no, there's fees and fuel taxes. Fuel taxes are actually doing okay.
Yeah, understand that those are super small change. When you say downgrade and upgrade, it's like both of those are rounding errors.
Yeah.
0.5% to 26, 0.2% to 27.3% to 28.
0.3. But there are things that we do every forecast that sort of don't show. So in the fuel taxes, for example, there is this move federally away from, green energy support and focusing on fossil fuel extraction. And so we changed the assumptions about how many gallons of gas are going to be consumed. And that flows through to the fuel taxes. Now that's, so more gallons of gasoline, that are consumed adds revenue there. But there's also a price effect with more fossil fuel extraction, and that'll lower gas prices. So that gains the motor fuel assessment tax. And so you get a little bit of offset. The net of that is slightly positive. But overall, there's still, our population base isn't growing, and there's efficiencies across all kinds of vehicles that are improving. So ends up declining, but not as fast. So that shows up as an adjustment that's slightly above the line. But it's the effect of things that are netting each other out. But that's the kind of thing we're doing continuously.
And on the fee side, a couple of years ago, we had a substantial fee increase in percentage terms. And so it's starting to work its way through, in terms of things that's starting to settle down a little bit. Whenever you have that big of a change, it's hard to know in some of the fees, what's driven by the fee increase or people buying less or more, paying lots of more in the way of fees. And there's a lot of fees. If you look at that other fee category, it's that low.
Yeah, other than that, consumption tax, the big consumption taxes, as Jeff said, are all pretty stable. So sales and use, motor vehicle purchases, use, and meals and rooms. Meals and rooms has been, impacted both by some cutting back in discretionary expenditures among middle and lower income taxpayers, and less foreign visitation, particularly Canadian. So the stat that we compiled in early December for a legislative briefing showed visitor counts at the Vermont visitor stations closest to the Canadian border down 35% through December 22nd. And if you go one visitor station away from those, they were down 17%. So it's, clearly the boycott from Canada is having an impact.
It's happening in upstate New York, New Hampshire, and Maine as well.
Yeah.
They're pretty mirror images of themselves.
I don't have a very good sense of scale in the meals and rooms tax with regard to tourism revenue. Is it the kind of change that could be offset by just like a really good snowy winter?
Oh, yeah.
On the same
It's
weekend?
small enough.
Okay.
Right now, because we had already accounted for some of that decline in visitation, but I think it's a little bit more than we expected. But yeah, a really good ski season totally changed it. Even December, starting early, we thought, maybe that's enough to do it. But then we got a lot of rain and ice, and it's different in the southern part of the state and northern part of the state, and on and on. But no, good weather, favorable weather for skiing would help everything. Yeah,
It's a little over 0.5%.
Because the West is suffering.
Yes, that's the other thing. Is right. The West is not
going to get.
That's helpful.
Yeah.
That's helpful. So that's why we only took it down about 0.7% the next 2 years. And if you look at the flow across the first half, actually the November, December period wasn't that bad.
And days like this that are cold enough to make snow help too. It doesn't all have to be.
Let's put it this way, all that 51st state stuff is helpful. But it's not, it hasn't been, and it's been tough, particularly on day visitation, which is a very significant part of our visitor base. But it's not fatal overall to things. It's just not helpful. And you could say that about several dozen things going on.
It might be interesting to look at JP, which gets lots of Canadian visitation. And you see it in the lick lines, you'll hear French and being spoken. And I don't know what their metrics look like compared to other ski areas, but that'll be interesting to see.
And on the upcoming International Emergency Powers Act, tariff Supreme Court decision, I'm deeply conflicted And on one point, I think they're probably not constitutional. On the other point, all we need is a decision like that, and they probably already got plans for how they're gonna go after getting them another way, and it's just gonna go through another round of disruption when it comes to tariffs. And as long as consumption is really important to driving the economy, that's not helpful either.
Yeah, and it's hard to believe we've talked this long and not even mention independence of the Federal Reserve Board, and what went down a couple of days ago. And again, that's the kind of thing, doesn't have immediate impact, but long-term is really costly. It's like taking research funds away from universities. You know, that has real significant long-term impacts on the economy, but you don't feel it right away. And there could be an immediate reaction to something more draconian affecting the Fed, but it's getting nibbled away in different ways. Clearly, there's an attempt to control interest rate policy from a political perspective. That would not be helpful in any way.
Start looking for inflation hedges.
Are you naming that as a risk that we need to be mindful of
Yeah.
in out years, but it's not included in any of the projections?
It's
yet?
not
Are you
included in the
assuming that
projections.
You're assuming independence for now.
Yes, that's right.
Okay.
In fact, I mean, it's already,
Yes.
independence has been
Yes.
shaken a little bit, but you don't see it in willingness to buy long-term US
Yep.
treasuries. The price, though, you know, I think there's a chart showing
Yeah.
treasury rates compared to the I was just so we're kind of on the same page with it, but you know, treasuries have not long-term treasury interest rate have not softened, which are also affect mortgage rates. Maybe I don't know.
And I have mortgage rates on page 30 of mine.
Okay.
And the Fed doesn't control mortgage rates, it only cuts short-term rate.
37, yes, the other, right.
And so when you end up in a situation where you've got the Fed under attack and concern about things, it doesn't matter if the Fed lowers rates when it's not being credibly done, because it doesn't affect the longer term part of the rate curve, because nobody believes that it's being done for an economic reason. If they believe it's being done for a political reason, you don't see any movement in the long-term rates, which is what the long-term objective of the current administration, I think, is that they want to see long-term rates come down, particularly for housing. I can't think of a way not to do it better than what they're doing.
Yeah.
So, yeah, on page 37, you see the federal funds rate, effective federal funds rate is a red line is dropping. But that gray line behind it is the 30-year treasury yield, and then mortgage rates are above that, and that's influenced by that. You see that's still climbing. And that's, you know, again, it's not something that, you know, happens immediately and you lose confidence in it and it becomes more expensive. And about 30% of the US debt is held by foreigners and creating enemies all around. But these are friendly nations for the most part, although China holds a lot of it too. But, you know, we depend on that's, you know, we're in a position of Greece if people aren't happy holding US debt. I'm not saying that's going to happen, but it's the kind of thing that, you know, once you lose it, it's really expensive, really difficult, and it's needless. We don't have to.
And the White House has instructed Treasury to buy $200 billion in long-term bond for the idea of bringing down rates.
Right.
So
That's also happening.
now we're going to see a mini Fed coming out of, you know, Pennsylvania having in that regard.
Can I go back to corporate taxes for a minute? So if corporate profits are up, is there a possibility of revenues? I mean, state revenues or federal revenues don't necessarily need to track profits if corporate taxes are being lowered. So how do you see that playing out here? So if the feds have, you know, this summer they lowered corporate taxes, right? So profit can keep on climbing, but that doesn't mean that revenue is necessarily.
Well, it depends if we're connected to them or not.
Yes,
And
exactly.
in many respects, a lot of the things that were in the OBBBA thing don't affect us. The one in corporate, I think that affects us is the accelerated depreciation part of it. And because we've separated from bonus depreciation in previous years, we're gonna have to make a decision on that because I don't know how the tax department's gonna be able to administer that with two different conflicting things. Most of the personal income tax provisions, like they have a credit, they have a deduction now for tips and social security for certain low income folks, and the overtime exclusions happen beneath where we're connected, so they're not going to affect us. The one thing that we don't know on the corporate side is those foreign provisions that were included and how because they have the potential to actually add some corporate income tax to us, but we don't really know that. I mean, how can we know what their income is in Europe or something like that for multinationals? So, insofar as how we treated it in the revenue forecast, it was basically decimal dust. And actually, next year, if we do get some revenues from the foreign, it can actually increase. But that depreciation measure, obviously, I think the legislature has to do something on that.
Yep.
And so that if for no other reason, the tax department needs to be able to administer.
I mean, you may see a longer term impact on corporate profitability too with AI stuff. If it doesn't result in products that make a lot of money right away, because these are expensed, the investment is a cost
Yep.
that reduces profitability. Now, these companies are super profitable, but it will dent them. The scale of this is so big, it will dent corporate profits there if there isn't added revenue from new products coming in as quickly as they hope. And there will probably be winners and losers in that. So that could affect corporate profitability much further out, but not immediately.
And, and we're still kind of working through it a little bit, but the 1%, the sales factor now, that was part of it when we went from the 3 factor to the 1 factor. Where, I mean, I think taxpayers have now gotten used to that. And so, obviously the thought was you get 1% of a lot more than when you got, a certain higher percentage in the 3 factor formula. So I think that's starting to settle down now. And I think we've gotten through any of the refund requests. There came from that.
There were some associated with that. They're used to
refund
paying,
requests,
more, and now it's less, and so they're getting refunded.
And put yourself in the comptroller's position. Do you want to go into your boss and say, hey, we're getting $2 million back, or say, we got to write a $3 million check every month? So they continue to pay, and now they're figuring out that maybe they didn't owe as much. And that's where some of the elevated refunding activity came from too. And that's, like I said, that's now largely, we're getting past that learning curve.
Also, so the K-shaped economy that you've talked about and personal income growth, do you have a sense of how much of that is sort of earned income, wage and hour, and how much of that is unearned income, capital gains type personal income, pass-throughs, et cetera?
I don't.
Okay.
Yeah, and a lot of times it's pretty lagged data that we get that breaks that out. But we'll be asking for it, when it's available. That's going to be.
And the dynamic of that a lot of times, by its nature, capital gains income, what happens is you have a household, it's not longitudinal data, it's always cross-sectional data. And so in year 1, you may have somebody in the 125, year 2, 130, year 3, 350, because they sold a deer camp or something, or they sold a second home. And then the 4th year, they go back down to 150. And there's people that, and every year that have those capital gains realizations. So it's really hard to separate out the cross-sectional data from the longitudinal.
And I'm less interested in real estate, real property capital gains, and more in the capital gains that would be connected to some of like the huge
The equity markets.
equity markets growth that you're seeing.
Yeah, people have to cash in for that to happen. And so that's always hard to know. Typically, if there's an announced change in the capital gains rate, then you can get a lot of people saying, oh, before that happens, I want to sell.
1986.
Yeah.
I don't really remember.
That was my first complicated forecasting problem.
What were you doing?
About that.
Back then, $100 million was something. $10 million or something back then. When I first started on Governor Stillings' staff in the summer of 1980, the general fund budget was $250 million.
And housing prices were,
Yeah.
you know, everything.
You could get a house for $1,000 a month mortgage
Yeah.
payment, not a car.
Yeah. Sort of our-
Any further questions? Have a motion?
I'll move to accept the state revenue estimates pursuant to 32 VSA 305A. FY 26, 27, and 28 as explained in item 3 in meeting materials.
And second,
Second,
further discussion. All those in favor, signify by saying aye.
aye.
All those opposed? The ayes have it, and you've approved, and then item 3. Thank you very much.
Thank you.
We'll now pick up agenda item number 4, the impact of authorized district from the ed fund. One motion will be required. We'll have Jake Feldman and Ted Barnett. Let them join us. And was that the sun blinding you? And we can shut this.
Yeah, that's fine.
If you like this, then we'll leave it.
Love.
The kinds of foreman.
Morning.
Good morning. Ted Barnett, Joint Fiscal Office, Jake Feldman, Tax Department. So pursuant to 32 VSA Section 305B, we forecasted that the maximum tax impact of authorized TIF districts on the education fund in fiscal year 27 is $9.3 million. Would like to note that this estimate reflects kind of the worst case scenario, and all development or incremental increase in value would have happened anyway. And so the amount of tax increment retained by TIF districts is a foregone cost, a cost of the education fund in terms of foregone revenue. This was a lovely consensus process because Jake and I used different methodologies, but we pretty much landed almost in the exact same place. So makes our lives easier when that happens.
Yeah.
Yeah. And Ted stole some of my thunder by saying it's the worst case scenario, assuming that all the TIF development would have happened anyway. If you take the opposite perspective, that none of the TIF development would have happened were it not for TIF, then the ed fund is actually up $2 to $3 million in FY 27. And if you, again, thinking in that lens, then when TIFs graduate, when they stop retaining increment, then the ed fund experiences a small bump. Winooski a couple of years ago ended its increment period. And again, through that lens, the ed fund gained a couple $1 million, and Burlington waterfront also just graduated this year.
Questions?
Do you anticipate adding chip estimates to this?
Like voluntarily.
Perfect answer. Thank you.
Yeah.
I'm good.
Chip starts this year, 2026 grand list.
Yes, so when we're back here, we'll have a full year of applications. We may, I think it'd be a pretty compressed timeline to start seeing impacts in fiscal year 28. They'd have to really be ready to go, but yes, we'll have some information on applications over the next year.
Yes.
Can you tell me what 9.3 million, how that affects the tax rates? I mean, what does that,
Sure.
what's the difference? Yeah.
Yeah, good rule of thumb for FY 27 is that, well, first I'll say that tax rates are a little bit wonky, but
Do you know that?
the average tax bill is projected to go up by about 12%.
Yeah.
And 16.7 million reduces that by 1%. So that means 9.3 is, 3/4 or a little bit less of
Okay,
1%.
thank you.
Okay, I move to accept the consensus estimate of the impact of the education fund in fiscal year 2027 of authorized TIF districts as explained in item 4 in the meeting materials.
Second.
Any further discussion? All those in favor, signify by saying aye.
Aye.
All those opposed? The ayes have it, and you've approved agenda item number 4. Thank you very much. We have one more agenda item, number 5, the education fund outlook. No motion is required, and if no one has any questions, I won't bring Julia Ricker up, but if you do, we can have her up.
I feel that, we have more than enough opportunities to discuss the outlook publicly. We don't need to speak.
Okay, so that objective will move forward and takes up agenda item number 6, other business. No other business, you have a motion to adjourn. All those in favor, to go to thing on.
Aye.
All opposed?